Trading live around the $15.23 mark with a market capitalization pushing past $73 billion, New Holdings Ltd. New World Inc. presents a fascinating disconnect between conventional retail financial analysis and the hard structural reality of its platform physics. If you scroll through financial Twitter, Reddit's retail investing boards, or mainstream financial commentary, the prevailing narrative surrounding Nubank frames it as a high-growth emerging market neobank, essentially a digital wrapper on top of volatile Latin American consumer credit. Analysts trapped in legacy mental models look at the double-digit price-to-earnings multiples, glance nervously at macroeconomic volatility in Brazil, Mexico, and Colombia, and instinctively lump New into the hazardous bucket of cyclical, high-risk emerging market financial plays. They treat it like an online storefront riding a fleeting post-pandemic wave. They are missing the core architectural truth entirely. New Holdings is not a traditional bank operating online. It is a hyperscalable, zero-legacy data infrastructure platform engineered to extract marginal cost advantages that legacy financial institutions physically cannot replicate. Traditional banks are weighed down by thousands of legacy brick-and-mortar branches, monolithic mainframe computer architectures built in the 1980s, and bloated cost structures that demand exorbitant account maintenance fees and exorbitant loan spreads just to keep the lights on. New bypassed this physical bottleneck completely. By building a native cloud infrastructure from day one, New engineered a structural unit economics moat where its cost to serve an incremental customer approaches zero, while its average revenue per active user, ARPU, expands exponentially as customers graduate from basic credit cards to multi-product financial ecosystems. While retail traders panic over short-term currency fluctuations in the Brazilian real or Mexican peso, institutional heavyweights understand that New's proprietary data stack allows it to underwrite risk with granular, real-time behavioral telemetry that traditional Latin American credit bureaus can only dream of matching. The market has consistently mispriced New because Wall Street analysts trained on legacy U.S. and European banking metrics attempt to evaluate a software margin operating model with old-school banking metrics like branch density and physical deposit-to-loan ratios. New is operating a high-velocity software distribution network disguised as a bank, quietly scaling across a combined user base topping 139 million customers and rewriting the rules of financial penetration across the entire Latin American continent. Market dynamics and institutional positioning, volume shocks, and accumulation zones. The daily trading tape for New Holdings reveals a masterclass in institutional accumulation masked by headline-driven volatility. With average daily volumes regularly surging past tens of millions of shares, amplified significantly following blockbuster earnings beats where quarterly net income crossed the monumental $1 billion threshold, alongside aggressive billion-dollar share repurchase authorizations, the stock frequently experiences sharp intraday swings. Retail traders, conditioned by short-term dopamine loops on commission-free trading apps, often get shaken out during macro-driven pullbacks or localized emerging market jitters. When a transient headline regarding interest rate adjustments or sovereign debt jitters hits the newswires, weak hands capitulate, creating acute liquidity vacuums. Behind the scenes, global institutional heavyweights, ranging from major asset managers like Vanguard and BlackRock to specialized growth funds and cross-border institutions like Bank of America and Sands Capital, step in precisely during these moments of engineered panic to absorb float. They are not trading the weekly chart. They are methodically building multi-year positions based on the relentless compounding of New's customer acquisition engine. Every time retail sentiment turns overly cautious because of temporary macro noise, institutional block orders accumulate shares below the fair value line. This dynamic creates a distinct volatility profile where sharp, compressed consolidation phases explode upward violently the moment fundamental catalysts, such as record-breaking efficiency ratios or unexpected banking license authorizations in key international markets, drop into the market. Before we unpack how Nu's operational machinery converts these volume dynamics into compounding free cash flow, take a moment to look at your own portfolio strategy. Are you currently holding a core position in new holdings through these choppy institutional accumulation phases, or are you sitting on the sidelines waiting for a deeper technical pullback to enter? Drop your thoughts or your average cost basis in the comments below. Business model and historical context, the deconstruction of legacy banking. To truly grasp where Nu Holdings is heading, we must deconstruct its operational segments and strip away the outdated historical framing that haunts its valuation. Founded in 2013 by David Velez, Cristina Junquera, and Edward Weibel, Nubank began with a hyper-focused mission to dismantle the notoriously anti-consumer, highly concentrated oligopoly of Brazilian banking, where a handful of legacy institutions squeezed retail customers with astronomical interest rates and egregious hidden fees. Initially branded as a simple, no-fee digital credit card provider distributed through a sleek mobile app, the company faced immediate skepticism from incumbent financial elites who predicted imminent collapse under non-performing loan defaults. Instead, Nu scaled its architecture into a comprehensive financial ecosystem built across three primary verticals: spending, transactional, and borrowing solutions. The spending layer, anchored by the flagship Nu credit and prepaid card, the premium metal ultraviolet tier, and the expanding Nubank Plus loyalty tiers, serves as the low-cost customer acquisition funnel. Once onboarded, users naturally transition into the transactional layer, utilizing Nu personal accounts and instant payment rails like Brazil's Pix network for daily cash management, effectively replacing their traditional primary bank accounts. The masterstroke of Nu's business model, however, lies in how it cross-sells high-margin borrowing and wealth-building products, including personal unsecured loans, goal-based investment money boxes, cryptocurrency trading, integrated insurance policies, and even lifestyle offerings like Nu Travel and mobile connectivity services via Nu Cell. Unlike traditional banks that incur massive customer acquisition costs through physical branch networks and commissioned sales agents, Nu acquires customers digitally at a fraction of the cost, driving a jaw-dropping return on equity that frequently exceeds 30%. The historical framing of Nu as a risky credit card startup completely ignores its evolution into the primary financial operating system for over 60% of the adult population in Brazil, while simultaneously replicating that exact playbook across Mexico and Colombia. Future outlook, catalysts, and risks, the multi-year expansion blueprint. Looking past the immediate horizon, Nu Holdings is positioned at the intersection of several massive structural tailwinds and technological gatekeeper dynamics. The primary multi-year growth catalyst is the maturation of its international expansion strategy, specifically in Mexico and Colombia. Having secured critical regulatory milestones, such as full banking license authorizations in Mexico, Nu is transitioning from a localized credit card issuer into a fully regulated deposit-taking institution in its secondary markets. This regulatory evolution unlocks massive operational leverage. Local banking licenses allow Nu to fund its lending portfolios with low-cost retail deposits gathered locally, drastically reducing its cost of capital and accelerating net interest margin expansion. Furthermore, the structural total addressable market remains vastly underpenetrated. While Brazil represents the mature engine room generating the bulk of the company's multi-billion-dollar profits, Mexico and Colombia boast massive unbanked and underbanked populations where informal cash economies still dominate. By exporting its battle-tested, high-efficiency digital operating model into these regions, Nu is replicating its hyper-growth curve on a compressed timeline. Additional growth vectors lie in the expansion of secured lending products, such as auto loans and deeper SME business banking accounts, which will progressively widen its moat against both fintech upstarts and slow-moving legacy institutions. Yet when we weigh these risks against the company's structural cost advantages, explosive structural compounding, and management's disciplined capital allocation, highlighted by proactive share repurchase programs and robust organic capital generation, it becomes evident that short-term price noise is merely a distraction for undisciplined market participants. New Holdings is systematically building a multinational digital financial titan. Investors who anchor their thesis to temporary macroeconomic jitters rather than the undeniable physics of digital platform scalability risk missing one of the defining growth stories of modern global finance. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.